Welcome to another webinar from PNF Accountants and Advisors. My name is Bishoy Fahmy, and I'm the founder of PNF. Today we're talking about a very important topic on how and what can I expense on my taxes and how to prove it in case of an audit. At PNF, we're specialized in a lot of industries, including but not limited to healthcare, nonprofits, auto dealerships and wholesalers, real estate rentals and leasing, construction and developers, manufacturing, transportation and warehousing, professionals like physicians and lawyers, and hospitality. So let's dive in to our topic today. Every expense has to have two factors. It has to be an ordinary and it has to be necessary. And in every audit that we do with the IRS or the state, they put the expense to these two tests. Is this expense really ordinary expense that is commonly and accepted in your industry? Or is it necessary where it's appropriate for your trade or business? So this is the secret to the madness, that everything has to be ordinary and necessary in order to qualify for the expense. And the reason this is important, because if you miss an expense, you end up overpaying your taxes. And if you deducted an unqualified expense and you get audited, you're going to be subject to penalty and interest. So you're going to end up overpay for no reason. So it's crucial that any expense, we have to put it to this test to make sure it's appropriate on the tax return. So let's take an example. Imagine you have a factory. The factory will normally have a raw material cost, freight costs, factory overhead, storage, and labor. These are expenses which is commonly and necessarily in this situation. Other expenses like advertising, continuing education, and the list goes on and on about insurance and phone and office expenses and rent and utility. So what we did, we compiled a list of all of these expenses so our clients do not forget any expense on their income tax. So if you need access to this full list, subscribe to our channel and we'll be more than happy to send it to you for free. Let's talk about capital expenses versus a normal expense. A normal expense will benefit 1 year and 1 year only. A capital expense will benefit more than 1 year. So imagine you're buying a car or a piece of equipment or a building. These assets will benefit more than 1 year, and that's why we capitalize it and we depreciate it over the life of the assets. So each year gets a percentage of this expense. So it's appropriate on the tax return. Other expenses like startup costs, expenses that you paid before you start your business, business assets and improvements. Talking about assets and talking about cars, a lot of clients ask me this question: shall I purchase or lease? And the lease basic is like a rent. What you pay, what you deduct is what you deduct. So if you lease a car for $1,000 a month, I'm expecting a $12,000 expense at year end. Versus a purchase, you can upfront the expense using Section 179 on your income tax. So if you're buying a $70,000 car and you financed it or paid for it in full, but as long as it's purchased and it's used for business, you can expense it using Section 179, in year one. But the car there's two limits. If the car is over 6,000 pounds, you can do that. If the car is under 6,000 pounds, there is a limitation because it's a sedan or a luxury car. If we're talking about tools, small tools, you can do a threshold, and this is an internal threshold, but you have to be consistent. A lot of clients use a $200 threshold, or sometimes it's $500. It depends on the business. And other business will do $1,000 threshold. And basically, this threshold, any tools that you're gonna buy over that number, it will be capitalized. Any tools that you're gonna pay or you're gonna purchase under the $200 in this example, it's just gonna be expensed. You're not gonna go through the capitalization process. And this is basically an internal policy that every business has to develop, and you maintain and you stay consistent with them. If we're talking about personal expenses commingled with business expenses, we have to be very careful with this. Because first of all, it's dangerous to commingle business and personal expenses because it can pierce the corporate veil in case of a lawsuit. But if this happened, and I'm going to give you an example, imagine you're a homeowner and you borrowed $100,000 on your house. You got a line of credit and used 70,000 of it, or 70% of this line of credit on a business venture, and you used 30% on a personal vacation. I would argue that the 70% of the interest paid is a business expense, and the 30% of the interest paid is a personal expense, non-deductible, of course. So that's how we can allocate a portion of that interest to a business portion. If we're talking about a home office, a lot of people and clients used their home during the last few years because of COVID, and they developed a home office. And basically, yes, you can deduct mortgage interest, insurance, utility, repairs, and of course, depreciation. All of these expenses can be deducted, but it has to subject to two tests. The first test, it has to be used exclusively, or the area dedicated for the office has to be used exclusively. The second portion, it has to be used regularly. What does that mean? That means you cannot use your dining room table. You cannot argue that it's used exclusively and regularly for business meetings. But I can argue that I have a room, a dedicated room, in my home for an office space, and because it's dedicated, I do not sleep in it, I do not eat in it, I only work in it. It's dedicated, and I'm using it exclusively and regularly for your trade of business. So if I'm meeting a client, I meet in this office. If I'm seeing a patient, I sit in this office. If I'm sitting with a customer, I meet in this office. That's how you can define it as exclusively and being used regularly. So the IRS came out with the safe harbor method, and basically it's 300 square feet. They allow safe harbor 300 square feet at $5 per square foot. So they allow $1,500 safe harbor method, and it's safer to stick with the safe harbor. If your allocation is above the safe harbor, we can use the bigger amount, but it's subject to an audit in that case. If we're talking about cash method and accrual method, this is crucial to your business. And if you are a small employer or small business, you can use either one. A cash method, it recognizes immediate recognition of revenue and expenses. That means if you collected $500 today, the 500 becomes income. If you collected 10,000, the 10,000 becomes income because you are in control of it. You collected it today. If you spent 500 or 10,000 today, becomes an expense today under the cash method. The accrual method, it matches the payment to the period that this income or expense happens. So imagine that you're selling a piece of equipment in December. but you collected it in January. You received the money in January, but the sale happened in December. Under the accrual method, that sale is a December income. Even that you collected it in January, the sale happened in December, so that's a December income. Under the cash method, that becomes a January income. So sometimes with the cash method, it's better or worse, depends on the client situation. A second example, imagine if you are buying a car, and if this car you received in December, but you paid for it in January. Again, under the cash method, whenever you paid for it. Under the accrual method, whenever the expense happens. So you have to be careful with when do you recognize income and expense under which method. Before we go into the personal deduction, let's talk about it's never too late to organize 2021 and to plan for 2022. You have until September and October 15 to get yourself organized and to file. So I would advise you, if you still need help with 2021 and you need our expense sheet to help you organize for your expenses of the year 2021, please subscribe to our channel and we'll send it to you. And if you have any questions, feel free to reach out to us and we'll help you with this. Let's talk personal deduction. So first deduction is the standard deduction. So single filer, we can deduct $12,550. Same thing with the married filing separate, $12,550. It doubles if you're a joint filer at $25,100. And if your head of household is $18,800. This is the minimum standard deduction that you can deduct on your income tax. We compare it to the itemized deduction. So we take your medical and dental expense and our state and local tax, including the property and real estate and sales tax and income tax and everything. And we add to it donations, and we add to it the mortgage interest and other deductions. And we compare the itemized deduction to the standard deduction. And we take the higher of the two. Keep in mind, if you're married filing separate, both couple have to either itemize or both of them have to take the standard. You cannot change. One can take the standard, one can be itemized. And after we compare the standard and itemized deduction, there's other additional deduction available to us. For example, the health saving account. If you're contributing to an HSA, you can deduct that. If you have a student loan interest that you paid, or if you have work-related educational expenses, or if you're a teacher and you bought some supplies, educational expenses. So these are available deduction. If you are an investor and you sold a home, you can deduct out of the sale all the costs related to the sale, your improvement, and the original purchase price. And if you're a homeowner and you lived in the house 2 years in the last 5 years, there is Section 121 exclusion. You can deduct $250,000 per person, $500 per married couple. If you are saving in an IRA, you can do a traditional IRA, you can do a simple IRA, or you can do a SEP IRA. If you have a capital losses, you can deduct a $3,000 from your income. If you have bad debt and you can prove that you lended somebody money and that person filed bankruptcy or cannot pay you and you have a judgment and it's uncollectible, you can claim that bad debt. If you're an investor in opportunity zone, there is a deduction for that. And of course, if you did any debt settlement, like a foreclosure, you abandon a property, or loan modification, or short sale, or even a credit card that you did a debt settlement on it, and you paid 80 or 70 cents on the dollar, and you received a taxable income for this event. If you did the right planning, you can exclude this from your income. Let's not forget the credits that's available to us this year. We have advance payment of the child tax credit, and we have the normal child tax credit. We have the recovery rebate credit. We have the earned income tax credit. We have the child and dependent care credit, adoption credit if you adopted any child, and we have the credit for older folks and disabled. We also have the saver credit if you're retirement saving, and we have the foreign tax credit. We have the excess of Social Security if you overpaid your Social Security tax, and we have the credit for taxes on undistributed capital gains, and we have the credit for prior year minimum tax. Under the homeowners, or if you're a homeowner and you did any energy efficient repair on your house, there is a credit for that. And if you purchase a vehicle, there is a plug-in electric drive vehicle credit. If you're in the marketplace for health insurance, there is the premium tax credit and the health coverage tax credit. And finally, if you are a student or you have students as dependents, in the first 4 years of college, there is the American Opportunity Credit, and after that, there's the Lifetime Learning Credit. My last advice during this tax season: get prepared, take your time. You can file an extension until September, October. Get organized. Do not miss an expense. Account for your income in full and account for expenses in full. With that, thank you for listening. And if you have any questions, please subscribe to our channel or reach out to us by email, and we'll be more than happy to answer your questions. Thank you.